Hello, I'm Molly, a licensed insolvency practitioner at Park Walsh, and in this video I'm going to be discussing selling assets when the company's in financial distress. So it's a common thing for directors to do when you're struggling for cash, maybe the turnover has dipped or the costs have increased or both, and you're selling assets that the company may no longer need to support its cash flow. And it sounds easy enough, but there are rules around it and you do have to be careful. So essentially, if you're selling an asset, first of all, look at what it is that you're going to be doing with the cash once you've sold it. So if the distress is sort of a temporary situation, that's fine. You get the cash and you use it to pay creditors or marketing, whatever it is that you're going to use the money for. If the company's going to go into liquidation, you just know that there's no way out of this, and the staff are going to have to be made redundant, and eventually you're going to have to close it all down. You may not want to use those funds to pay creditors if you can't pay all the creditors, because one, you might prefer a creditor above the other, which is a preference payment, which then has risks to the director personally, but also you will need to cover the costs of the liquidation. So we've seen it before that directors come to me, the company's in financial distress, the only asset they had was a van, which they've sold. They've used that money to then pay one creditor off. Well, the other creditors, have been treated unfairly because you just paid that one creditor, you preferred it. So there's difficulties with the director there, and he can be personally responsible for that money. But also the liquidation costs, he then has to put his hand in his own pocket to cover the liquidation costs. So when you're looking to sell assets, just be careful or mindful as to what you're going to be doing with those funds. Are you going to need to ring fence them for liquidation costs? But see, if you're selling the assets, you need to make sure that it's done for fair value. So what is fair value? And I mean, it depends on the type of asset. Obviously, a motor vehicle can be quite easy to value, whereas a website is obviously a lot more difficult to put a figure on. But you have to sell it for fair value because you don't want to enter into a transaction that's known as a transaction at an undervalue, because again, it has risks to the director personally. So make sure that you know what the value is, and you could get an online valuation or instruct an agent and they'd be able to assist, but obviously that can be quite costly. So it depends on what type of asset and the possible value of it. And make sure you're selling it, you're marketing it, so that can give an indication of its value, because obviously if there's lots of people interested in that asset, you get the best that you can for it. So that gives an indication of its worth. Make sure you fully document everything, because if the company later enters into, say, liquidation or administration, your actions as a director are going to be examined, and you need to be able to prove that you have done everything correctly. The onus is on you as a director. So make sure you keep good records. Now, say for the example of selling a motor vehicle, you type in your registration, the mileage, current condition. It gives you a value, and maybe you sold to the online platform, or maybe you sold it, by private treaty to someone. And you think, well, I've got that valuation, it's enough. Well, actually, how are you going to prove the mileage and the condition of the vehicle? So make sure you're taking photos. So take photos of the vehicle, take photos of the mileage on the dashboard, and take a photo of the vehicle registration, and then you've got it if anyone asks. Maybe get one or two valuations, especially if they're free online ones, so that you've got a range to evidence the cost of it. And then when you come to sell it, minute it in the company records, because it's a decision that you're doing. So just make sure that it's minuted and the reasons for it. And then the actual sale obviously you need documentation there. So it all depends on the asset type and the value, whether or not an invoice would suffice, but also if it's larger, maybe more assets or a large value, you might want to use a sale purchase agreement. If someone's paying on deferred terms, i.e. a lump sum up front and then monthly consideration, what security are you getting for that? Because that person, the purchaser, may just make one payment, they've got the vehicle or whatever it is, tables, chairs, and you don't get any more payments. You as a director are at risk there because you've let an asset go without property security. So if dependent on the value of the assets you're selling, but you might want to get a debenture against the purchaser, or you may want to get a personal guarantee from the individual if you've sold to a limited company. If you're selling to a limited company, check out their limited company, check their accounts, make sure it's a profitable, legitimate company, etc. So there's lots of things you can do, but what I would recommend is that you speak to someone like myself, insolvency practitioner, so I can advise you as to what the rules are and what you should be doing, because you don't want to do anything unintentionally that can leave you open to personal liability or even disqualification as a director. And you might want to speak with an agent. We can recommend agents to you who have the correct qualifications and insurance, but then that takes the risk from you because you've hired a professional to do it. And then once you've got the sale consideration, make sure it's paid into the company bank account. So don't obviously put it into your own personal bank account, and make sure you're using it for legitimate business expenses only. But going back to my original point, just be careful that you're not preferring one creditor over another. Make sure that you don't need to ring fence it for, say, liquidation fees later down the line. So just have a plan with what you do with the money once you've got it. Okay, so I hope that's helped. Thank you.